We're going to unpack the largest leveraged buyout in history. There's a looming threat to the dominance of REA and Domain. We're back with Unhelpful Desk, where we provide general answers to your personal questions. And who said banks aren't boring? We're going to show you why they're not. Welcome to Equity Mates Investing, a podcast where we explore what is possible in the world of investing. If you've just joined us for the very first time, a huge welcome to our community. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. There is a lot happening in news, in markets. As you said, we're answering a number of questions from the community, particularly around superannuation, as the ripples of Super September keep echoing through the community.
Yeah, it's good to see.
At least the Equity Mates community.
Yes.
Hopefully we can push it into the broader community. But there's a lot to cover, so let's get into it.
News and markets.
Ren, headlines we're covering this morning: EA's record acquisition. There's a looming threat to REA and Domain. And I'd love to be able to tee up the third one, but you said it's a surprise, so we will get to that.
All right, well, let's start with EA because, it's not the largest acquisition in history, let's be clear. There have been bigger ones, but it is the largest private equity takeover, largest leverage buyout and particularly here, where a publicly listed company is being taken off the share market by a consortium of private investors. First of all, Electronic Arts, EA, you familiar with it?
They do FIFA.
They
FIFA
do
game.
They do FIFA. That is not all they do. Some of their best-selling franchises, FIFA is number one. The Sims, Need for Speed, Madden, Apex Legends, Battlefield, Medal of Honor. Some
Huge games.
Big hitters in the gaming world.
Yeah.
They are being taken private at a $55 billion price tag by a consortium led by Jared Kushner, Trump's son-in-law, his investment fund, the Saudi Arabian, it's called the Public Investment Fund, but it's their sovereign wealth fund, and a private equity player that has been busy of late, Silver Lake.
Yes, you may recognize that name. They have been involved in the TikTok acquisition of here over in the US. So it's good news for the EA shareholders, Ren. They will receive $210 per share, which represents a premium of 25%.
This introduces a philosophical question, Bryce.
Yeah.
Is it good news for EA shareholders? Because on one hand, yes, today they're getting a 25% premium to what the shares were trading at. But if you're an EA shareholder and you believe in the long-term gaming thematic and EA's ability to execute on that theme, and you think that over the long term EA can be far more valuable, then I would argue that it is not good news because you're losing that long-term opportunity.
You are.
And instead, I was about to say some rich assholes are getting it, but once again, it's like those with wealth are taking these public companies off the board, and so we can't participate in that.
No.
And instead, they'd get to.
Yeah, look.
This is obviously this is a source point for me.
As a shareholder who can't really do anything about it, you'd be happy with a 25% premium.
Yeah. And I get time value of money, you get 25% more today rather than it taking time and you can redeploy that money. I get all those arguments, but it's the same argument with, Sydney Airport here. That was a long-term asset that everyone could participate in, everyone could invest in, and instead it gets taken off the boards by the super funds and some other private funders. So it's an ongoing theme we're seeing. The number of listed companies is going down, partly because companies are not listing, and also partly because listed companies are getting taken off the boards. But I think we're going to wake up too late and realize this is not a good thing.
Yeah, I mean, the counter argument is that slowly we're seeing green shoots in accessibility to private markets, very slowly.
Still not the same.
But,
the ability to access a private fund still relies on the fund manager, still has the fund manager taking fees. You don't have that direct, I can make investment decisions myself.
Not yet. I reckon in 10 years it'll be completely different.
You reckon? You reckon there'll be a pseudo share market, just not like the ASX?
I think
there'll be the ability to buy and sell direct ownership stakes in companies just off a share market.
I reckon.
Well, I hope so.
I
hope so. Because I genuinely think we're going to wake up one day and say, all the companies that are generating all the wealth are in private hands. That does not do good things for inequality.
No.
Anyway, Let's get back to the investing
Yes.
story. So that's EA. I think it's deal season because TikTok is also, that deal seems to be progressing. We're also seeing a number of IPOs come to market. So I think like we're seeing a bit of a frenzy of deal momentum at the moment. So I imagine we're going to see more in this space.
Yeah.
But let's come back home. Let's talk about REA and Domain, the real estate listing platforms who have been dominant businesses, particularly REA. It has been a great investment, but a looming threat has snuck up behind them.
It has. So obviously REA has been one of the biggest winners of in Aussie portfolios. It's up 23% per year for the last 5 years. Pretty incredible growth. Yeah. So before dividends, to compare that, the ASX 200 is up 11% per year on average. So pretty phenomenal outperformance. One of the reasons, Ren, it has done so well is because it is not cheap to list on the platform.
It is not cheap.
It is not cheap. Homes can cost up to $6,000 to list for sale on one portal, depending on the suburb that you're in.
Yeah, so that's like REA or Domain.
Yeah,
And
which is...
generally you're listing on both.
Yeah.
But here's a crazy stat. Prices are up almost 5,000% over the past 15 years, prices to list. So they certainly have pricing power.
Big time.
But there is a looming threat, as we said, because here's a surprising stat. 1 in 5 homes in Sydney that sold last year sold without listing on a real estate platform.
Yeah, that's incredible.
So the numbers vary from local area to local area. In Sydney's Northern Beaches, more than 1 in 3 homes, 35% of homes sold off market, well, at least off the real estate listing portals. In the Ku-ring-gai local government area, it was 30%. And so I think what we're seeing is real estate agents figuring out ways to sell these places without having to pay an arm and a leg to portals.
Yeah.
And also the rise of buyers agents buying properties, you know, quote unquote off market.
Yeah, well, that's kind of where I went because I had a look at the stats because I feel just through how you've bought your home, how a lot of our friends are buying homes, are now more and more turning to buyers agents to try and, I guess, find properties in a market that's pretty top heavy at the moment. Over the last 10 years, the number of buyers agents in Australia has doubled.
Yep.
And there was a 2023 study by Property Investing Professionals of Australia that showed 40% of buyers consider using a buyer's agent, up from 10% a decade ago. And we know that the biggest sell for buyers agents is that they have unlisted properties. So I think it's a trend that we're going to just see continue.
Yeah, and now the irony is there's this new platform called Quiet List, which published some of this data, which is like for off-market houses.
Actually,
but then it's like
not off market.
Exactly. Exactly.
I found that really interesting when I was going through the process. You'd have the real estate agents email you directly to a mass list with off market opportunities.
Yeah.
It's like, that's not off market.
Yeah, like are we just saying it's like
not listed on
it's not listed on these
REA
portals.
Yeah.
So it's still on
It's still
market.
pretty-
I asked this of we went on a property investing podcast and I asked this of the host. I was like, will we get to a point where there's just enough buyers agents that you almost have like 2 market periods, one where there's like multiple buyers agents with clients competing for listing or like for buying opportunities and prices, and you almost have like a pseudo auction amongst buyers agents.
Yeah.
And then only if you can't get through that will you then
the scraps go to REA.
Yeah. And they were like, nah, that would never happen, blah, blah, blah. But it seems to be happening in some way. Yeah. Because real estate agents, like as buyers agents proliferate, they'll have the opportunity to play buyers agents off against each other.
Absolutely.
Buyers agents, obviously more sophisticated buyers and more price sensitive, you would expect.
Yeah.
But yeah, it's an interesting one to watch. It'll be an interesting one to see if these numbers continue, what that means for REA and Domain as well.
Yeah.
Like all of a sudden, if they have to start cutting prices, and there's like a competitive threat, that will be an interesting dynamic that we haven't seen in a while.
Yeah.
REA boldly raised prices 78% on real estate agents last year. I don't know if you saw that.
No.
ACCC investigating it.
Really?
Yeah.
Whoa. Good business. Good business.
Good business. All right. Well, Bryce, you said earlier you wanted to introduce the third story, but you didn't know what it was.
Yeah, very hard to do.
Because I wanted to capture your reaction to what I was going to share with you. So,
Okay.
South Korea. When you
Nice.
think about what it's known for, one of the big things is it loves eSports.
Yep.
Like they have eSports stadiums
Yeah.
in South Korea.
Yeah.
Well, forget StarCraft because South Korea has a new favorite game.
Okay.
It's trading.
Trading.
So let me show you
Stock
this.
trading.
Let me show you this video. If you're watching on YouTube, we'll insert it. 2 participants are given crypto accounts with the same amount of money, and the game is who can double their money faster.
No way.
But then
in a simulated environment?
No, in
live?
live crypto environments. But then here's the rub, and this is why I knew you would love it. South Korean bookmakers have now created a whole gambling. You can now gamble on this eSport.
Like you can gamble on who's going to win.
Who's going to win.
Oh my goodness. That's a leveraged gamble.
So it's like all the worst parts of the market really in one. It's like crypto trading, incredibly short term, and then people gambling on it.
Wow.
Yeah.
Wow.
What do you reckon? Do we bring the Equity Mates crypto trading league to Australia?
Yeah, let's do it. But you can only trade long-term ETFs. The game goes for 10 years. Wow, I'm looking at it. It's pretty crazy.
Yeah, it's nuts.
Wow.
So this is in one of their like eSports stadiums.
And I wonder how long they have to do it. Like, who are these guys? They reckon they can just double that. And they'd obviously just be trading shit coins and leverage. And
I'm not sure it's timed because the winner is whoever doubles their money faster.
That's what I mean. Are they just sitting there for 2 days?
I kind of assumed when I first heard about it that it would be you have a set period of time. It's like the game is an hour and it's who can have the bigger portfolio at the end of the hour.
It.
Yeah, but I did read somewhere that you had to double it.
The winner we should get on for my 500 to 5,000.
True. There's probably multiple game formats. It's like tennis. You got singles, doubles, mixed doubles.
True.
Here you've got like an hour game. You got double your money.
It's bad that they've got gambling on top of it though.
I know.
Wow.
It's nuts.
With equal balances, and the winner is whoever doubles their capital in the fastest within a set time limit.
Oh, okay.
Yeah.
Well, how can you have the doubling?
Yeah,
and
it's weird.
Yeah.
Finance game skill, part luck and pure adrenaline. Wow.
All right. There you go.
We should fire up an Equity Mates trip to South Korea and see if we can get amongst the action. Anyway, if you want to keep up with all of the headlines, make sure you subscribe to our daily newsletter. There'll be a link in the show notes or the description below. We'll send you a summary of the news headlines straight to your inbox at 6 a.m. every morning. Welcome to the Unhelpful Desk, a segment where we answer your personal questions in an unhelpful general advice way. Ren?
We try to be helpful within the bounds of our Australian Financial Services license.
That's right. We know nothing about you. We can only answer in general advice terms, but we do get plenty of questions from the community that are very specific. So what we're going to do is go through a number today to give our best at answering them in general form. So Ren, let's kick off the first one that has come in from Jeremy.
Hey guys, love the podcast. Just want to get your thoughts on an SMSF versus a super fund that allows you to invest, such as an Australian Super Member Direct or Australian Retirement Trust. What is the difference? And I'd love to hear whether you reckon both my wife and myself should combine in an SMSF or we should keep our own separate sort of member direct investments. Cheers, guys.
Awesome. Thank you so much for the question, Jeremy. A reminder that if you want to submit a question, head to equitymates.com/contact and leave us a voice note. All right, Ren, well, let's just start with firstly defining the difference between the two.
Yeah, I think this is an important thing. We spoke at a corporate gig recently and we were explaining this where traditionally there was self-managed super funds which gave you control, and then there was like industry funds or retail funds where you could set your asset allocation, but that was about it. Yep. But really over the past, 5-10 years, the space in between those two have really filled in.
Yeah.
And a big one is this member-directed super fund, where it's still in a super fund structure, but you have a lot more control over how you invest. Yeah. There is sometimes an investment menu. There's sometimes guardrails about how much you can put in any one asset. So it's not complete control, but it is a lot more control.
Yeah.
And so that's what Jeremy's referencing here. A self-managed super fund is a private super fund managed by its members, and you have all the compliance and admin and audit costs and responsibilities associated with that.
Yeah. And full control over asset allocation. Full control. You can invest in anything.
Yes. You can invest in
you can
property,
do startups,
collectibles. Yeah.
It's
Pokemon cards.
Pokemon cards, full control.
Member-directed super funds are still within the compliance regime of a super fund. And so they take that burden. Generally, they will be lower cost and they will be lower compliance headache as well, but less control. You're not putting Pokemon cards in your Australian Retirement Trust member-directed fund. Yeah. So I think, Jeremy, we can't tell you which one is right, self-managed super fund or member directed, but I think those are some of the factors you could consider that we've just touched on there. The control you want, the assets you want to invest in, the time you want to spend on it. The second part of the question was around combining his super with his wife. So that is something that is available for self-managed super funds.
Yes.
You can combine super. You can combine super with actually up to 6 members.
Yeah, with anyone. You and I could have a self-managed super fund.
Wow, that would be we would
High
be doing
risk.
we would be doing that South Korean crypto trading game. Yeah. So how would you approach this part of the question?
So we've heard rule of thumb, Ren, plenty of times from financial advisors that firstly, you want about $300,000 minimum because you have to absorb all of the costs that come with running a super fund, all the admin costs and those sorts of things. The second consideration is what do you want to be investing in? Like if you want to be investing in property, Pokemon cards, unique assets that you can't get, then that's probably the biggest consideration. And whether or not you want to be combining it with your wife or your partner, I guess is a personal decision as well.
And if you're pitching Pokemon cards, she may not want to combine it with you.
Exactly. I mean, you generally, would want to be on the same page when it comes to that sort of stuff.
So let me wrap this question up with some general thoughts that how I would personally approach this decision. First of all, self-managed super fund or not, I would say if you have a specific reason to move to self-managed super fund, sure. Like if you've got a specific asset you want to invest in, you've got a specific goal that is facilitated by a self-managed super fund. But I would say if you don't have a reason to do it, the choice and flexibility you get these days without an SMSF, I feel like can lend itself to just not dealing with the headache. So that would be my first thought. Similarly, that would be how I approach combining super with my wife. It would be like if I've got a reason and that together we can achieve a goal that independently we couldn't achieve, then that is a reason to do it. But my default for me personally would be there's no reason for us to combine. And so, I think it's like really understanding like the why you want to do it. And if you don't want to do it, I would err on the side of having the lowest fees, the lowest complexity and compliance headache, and the best investment expertise at your fingertips. And I would say probably don't invest in Pokemon cards in your super. Just invest in sensible long-term assets.
Yes. All right. Well, thank you for the question, Jeremy. The next one comes in from Bailey.
Hi guys, Bailey here. Just wanted to ask a question with it being Super September around high growth options. With Australian Retirement Trust, they have both a high growth and a high growth index option. The index one has very low fees in comparison and claims to have 90% growth assets rather than 85%. It is very new though, so there's no track record on returns. Just wanted to get your thoughts on this and see what you guys think.
So this is an interesting question from Bailey. I don't think they're the only super fund to have a index sleeve and then like a non-index sleeve. So it's something that we sometimes get questions about. Just to quickly illustrate them with Australian Retirement Trust, their high growth fund has been around for over a decade. We had a look at its 10-year performance, about 9.4% per annum. So like it's delivered some decent growth. The high growth index option is newer and it really is focused on low cost index based investing. The ASX 200, the S&P 500, those kind of share market indexes is really the bulk of its assets. So the question is, do you want a more actively managed high growth approach with a more varied spread of assets? You will probably have more infrastructure and stuff like that. Whereas the high growth index option is more consolidated but lower cost as a result.
Yeah, I think you're right, Ren. So let's go through some of the key considerations. I guess just to add to that, so the index option is 40% Australian shares, 50% international, and 10% fixed income. So that's where you've got the 90-10. So pretty much 90% growth assets there. So I think the first consideration is fees. We always talk about fees, and you want really the lowest fees possible if the product is the right one for you. I get the sense Bailey has a bit of time on his side. I don't know why I sense that, but I could be wrong. But I would be looking at getting the fees as low as possible in a high growth fund. So the high growth index option has significantly lower fees, as he pointed out. So that's the first consideration. Second is the investment style, active management versus index, which you pointed to, Ren. Again, we know the differences between active and index, and then looking at track record. New to the market, but I would be surprised.
You could look at the underlying indexes to see the track record.
Yeah, I was going to say, like, we kind of know how these indexes have performed.
Yeah.
So you could probably do a bit of work yourself to understand how the Aussie market's gone over the last 5 years and how international has gone. And they're very much in line, I would say, if not a little bit better than, well, in line with the high growth options.
Yeah. Look, I think we can't give you the answer, Bailey. I think they both seem like good products. The fact that you're looking at high growth and you're thinking about, like a multi-decade time horizon is the important thing. If you're an investor that likes the idea of experts actively managing your portfolio and making investment decisions, the existing ART high growth option has a great track record. If you love the idea of indexes and that's what you're comfortable with and you're looking to get the lowest fee possible, then this high growth index tracking approach makes sense. And then my final thought would be just think about your portfolio as a whole. And if you're like 100% index ETFs outside of super, then just think about the diversification between super and non-super assets as well.
A generic answer to Bailey's question. That's why we call it the Unhelpful Desk.
That is how it gets its name. Look, we say what we can and we don't say any more.
Yes.
All right. Well, in that spirit, let's listen to the final question from Reese.
Hey boys, just a quick question about super. 35-year-old with $90,000 in CBUS Super, think about switching over to Vanguard Super. Just want to know some pros and cons about each one and how to go about changing over.
Reese, thank you so much for the question. Here comes a very generic answer to it. It kind of wraps up, Ren, into what we just spoke about for Bailey, which is really what Reese needs to consider here is, do you want the active management that has a bit of a track record where you're going to get a bit of a varied mix of underlying assets, or do you want to go down the route with Vanguard, which we know is like an index-based superannuation approach, but with lower cost involved in that?
Yes.
So look, I think it's look at the underlying funds. If you are new to the show and really want to understand the difference between the two, I would suggest just going to Get Started Investing, where we unpack, index versus active management. But that's really the consideration here.
Yeah. Let's answer the second part of Reese's question because we can be a bit more specific there around how to change your super fund. And he asked specifically about changing from CBUS to Vanguard. But I think we can say generally, if Super September has inspired you to look at your super fund and you think there's potentially a better offer out there, then in terms of how you do it, they make it very simple these days. So the steps are, well, first of all, check if there's any exit or withdrawal fees from your current super fund.
That'd be
dogs if they charge it. Seriously.
Yeah.
But then just go to the new super fund and sign up. These days, most super funds you can sign up online, most, not all. Initiate a rollover request. All super funds will have a function for you to bring your super over to them. It will sometimes take a couple of weeks just for the process to migrate across. Most super funds these days are pretty tech forward and they let you do it. But here's the last thing and the most important thing that people often forget. Make sure you tell your employer that you've changed.
Yes.
It's all good and well to, have the rollover of your existing super, but make sure you update your employer with new fund details. There's a lot of super funds will have like a generic letter that you can download and then give to your employer. You don't want to have your new contributions going to your old fund and your main super sitting in the new fund, because that is a fast track to duplicate fees.
Well, there you go. Thank you so much for the questions, Jeremy, Bailey, and Reese. Keep them coming in. We'll do our best to answer all of your personal questions in a general advice way.
Yes, and if you have any general questions, you can hit us up at equitymates.com/contact and we will also answer as many of those as possible.
Yes. Now, I've been reviewing my Super Ren as part of Super September, and there's an ETF in there that continues to surprise me, which also shows why banks aren't boring. We're going to unpack it right after the break. We'll be right back. Welcome back to Equity Mates Investing. Ren, as part of Super September, I did a review of my super portfolio, just to remind myself of what's in there.
Yeah.
And there is an ETF that I spoke about on Get Started Investing that is in my super fund that I want to talk about today. It's the Banks ETF, BNKS.
Yes.
The Global Banks Currency Hedged ETF. And if anyone thinks that banks aren't boring, I suggest they look at this ETF.
Oh, I think you just screwed up your delivery there.
Banks are boring.
All right.
For anyone who thinks banks are boring.
Well, look, Australian investing gets tagged with banks and miners, boring, nothing exciting. So you're swimming against the tide here.
Yeah.
So make the case.
This is an ETF that gives exposure to the largest global banks ex-Australia.
Okay.
So that is very important.
Yeah, you've already excluded Australian banks.
I've excluded as the world's most expensive banks.
But also one of the world's best growth stocks that looks like a bank,
True.
in Commonwealth Bank.
This ETF top holdings include JP Morgan, Bank of America, Wells Fargo, Royal Bank of Canada, and HSBC, the big global investment banks. Why am I excited about it?
And consumer banks.
And consumer, yeah. Why am I excited about it? Listen to these returns, Ren. Last 1 year, 38%. Last 3 years, 25% per year. Last 5 years, 21% per year. Over the last 5 years in total, it's up 150%. Since inception, it's pumped out 11.5%. per year.
Okay, well, that's kind of coming back to index level returns.
Yes, but that's because you got to consider what's gone on in the banking landscape over the last few years, which we'll get to that. But last 5 years.
When was inception for it?
So 2016 was when the fund hit the markets.
Okay.
So 10 years, call it 9 years. Let's compare that to the ASX 200. So the last 12 months, ASX is up 7%. For the last 5 years, it's up 53% in total. So compare that to 153%. If you look at the S&P 500, it's up 16% over the last 12 months and up 98% over the last 5 years.
So just to recap for people who just heard you say percentage a lot.
Yeah, good percentages.
Over the past 5 years, you've got the ASX 200 up 53%. I assume that's pre-dividends.
Yeah.
And then you've got the S&P 500 up 98%. And then you've got this bank's ETF up 153%.
Correct.
Over the past 5 years.
Correct.
Okay. So that is starting to build the case why banks aren't boring.
Yeah.
That is the past. And as we always hear, past performance, not an indicator of future performance.
Yes.
So
Yes.
why is this exciting going forward?
The investment banking world is having a bit of a renaissance at the moment. And we spoke at the top of the show, big deals are getting done. The IPO market is warming up.
Yes.
And this is where investment banks come into play.
Well, for example, this EA deal that we spoke about at the start of the show, the bank that is providing the $20 billion in debt for the leverage buyout is the largest holding in this ETF. JP.
There you go.
Yeah.
For context, 2022-2023 was not great for investment banking. That was when interest rates skyrocketed, IPO market died, M&A froze up, and geopolitics events started to really heat up. However, since then, 2024, things have roared back to life. So investment bank revenues are back. JP Morgan reported revenues up almost 50%, Citi up almost 35%, Goldman pulling in fees of $7.5 billion. Global investment banking revenue is back. So we are seeing a period now where there's much more activity in mergers and acquisitions. And, as we've spoken about, IPO market is warming up as well, which is great news for investment banking. So that's the first factor. The second factor, Ren, is deregulation. It's obviously one of Trump's big mandates. He came into the election to his sort of next 4 years saying that there is going to be lighter regulation on the financial industry. Not to get too much into specifics, but one of the key, pillars for this regulation is what they call the Basel III endgame, which is where they were really going to tighten up the requirements for banks to hold excess cash. However, Trump is delaying that. There's a report from Oliver Wyman that shows by Trump delaying banks having to hold this excess cash, it's going to put an extra $650 to $750 million into the bank's pockets.
I think you mean $1 billion.
Sorry, you're right, $1 billion into the pockets of the banks, which of course can go towards dividends, buybacks, and lending out cash. So this is an expectation at the moment. It sort of hasn't necessarily played out, but another factor why so many people are getting excited about the banks.
At some point, the additional cash reserves will go on.
Yeah. But until, we've seen what Trump does, keeps kicking cans down the road, and he's obviously
He's not going to be president forever.
He won't be. He won't be, of course.
I don't know. It's interesting for me. When you initially said I want to do a segment on the banks, for me, over the long term, I struggle to see how this bank ETF will massively outperform the market, because in my mind, banks are kind of just like GDP plus in the sense that particular banks will outperform, they will disrupt, they will innovate, they will find ways to be more efficient. But the global banking sector as a whole is really, you would think, just a function of like it's GDP, it's like corporate growth, and then like banking as a whole is reliant on, like consumer banking is reliant on savings for like they can lend what that people deposit. Is there an argument that it will ever be, like tech, you could say, I could see how that would massively outpace GDP. Is there an argument that banking can do that?
Well, the stats show in developing countries, the banking's outpaced GDP by a factor of about 80%, and in developing, it's 200 to 400%.
Over what time period?
I don't have that data.
Where did you get that?
I got it from our good friends Claude.
Okay.
Yeah. Because I did look at this. China's GDP, for example, grew 8% annually. The banking sector grew 15%.
Yeah, okay.
Financial services outpaced economic growth by a factor of 2 to 1.
Nice.
So I know what you're saying, but I think the stats kind of show otherwise.
Yeah. The third leg of that stool for me, it's like, like corporate earnings growth would drive like M&A, and new business formation will drive all this stuff. Then like consumers getting wealthier, saving more, taking on more debt, buying more expensive houses, all of that stuff will drive banking. The third leg of the stool is more people being banked.
Yes.
Because there's still huge populations that are underbanked. Now, the top of your ETF aren't exactly going to benefit from that. JP Morgan, Bank of America, Wells Fargo, Royal Bank of Canada, HSBC, maybe, but there are some banks that are seeing huge gains in that space. And we've spoken about a few of them, particularly with some of the active managers who focus on India that have come through, like HDFC Bank and the like. But there's one bank that I want to talk about.
But, okay, before we move on, Ren, I do want to just touch on that point, because for me, this is the interesting part for the banks, because unfortunately, as global inequality increases, particularly in countries like America, and let's put some stats to it, we saw a 4.2% increase in high net worths in 2024 globally, with the population growing by 2.6%. These are the banks that actually capture a lot of those people.
Yes.
$83 trillion is set to be passed to younger generations by 2048, according to the World Wealth Report. US dollar millionaires are rising year on year, with high net wealths growing at a pretty significant pace, almost 8% a year in the US. And so these banks are positioning themselves for those people. And so I think, unfortunately, as the global inequality rises and more people get richer, these banks tend to pick up those people. And you might question, well, where do the revenues mostly come from? If you look at Morgan Stanley, roughly 50% of their revenue is serving high net wealths, first corporate, whereas Goldman, it's a little less, 60-40 towards the corporate side.
All right, Bryce, a bit dystopian. We don't love to see inequality rise, but whilst we fight to change the system, it's incumbent upon us to do our best within it. Yes. And so this might be a way to do it. Am I able to talk about my favorite bank now?
Yeah, go for it.
So I want to talk about a bank that first came up in a Pimp My Portfolio segment. I'd never heard of it. And then we spoke to someone who was investing in this Brazilian bank. And I've kept it on my watch list ever since. And it is nuts, some of the numbers. So given that you introduced the topic of banking, I thought it was a good opportunity to bring it to the table. The company is New Holdings. It's listed in New York. The ticker is NU. Let me tell you about it quickly. It's a Brazilian bank, digital first. It's up 1,500% in the past 5 years. And yet, it still only trades on a 33 times price to earnings ratio. So it started in Brazil, and it now has 60% of Brazilian adults as customers. And now it has expanded to Mexico and Colombia. And just to give you a sense of the growth in the past 5 years, so this is across all three countries, it's gone from 42 million customers to 123 million customers, 31% annual growth rate. Revenue from 336 million to 3.7 billion, 85% compound annual growth rate. And profit, it went from losing 15 million to making $637 million over the past 5 years. But here's the number I want to share. So it entered in Mexico and Colombia. In less than 5 years, it went from 100,000 customers in Mexico to 12 million. Jeez. It grew customers at 190% compound annual growth rate.
Wow. What's the market not getting about them then? Why is it relatively cheap.
Well, it just keeps growing into its valuation. Yeah.
Wow.
So who knows where it goes from here, but like, it's impressive.
Where's it listed?
New York.
NASDAQ?
No, New York Stock Exchange.
NYSE.
Yeah.
Nice.
For me, like the Latin American story of Mercado Libre and Nubank and just like getting people banked and connected to commerce through their phones is a really incredible story playing out.
Yeah, I was going to say there should be a Latin American ETF, but there's heaps. So
There's heaps.
yeah.
And the question again with all these emerging market ETFs is what's at the top of those ETFs? Because I would guess it's not Mercado or Nubank.
You might want to take that back because the top holding for the iShares Latin America is New Holdings.
Okay. All right. Well, I guess I slightly take it back. What I don't take back is that when it comes to emerging market ETFs, you've got to be careful because you've got to look at all the holdings and whether they align with the thesis that you may have, be it, you know, an emerging consumer class or digital and internet penetration. Does that align with everything in the ETF or just some of the holdings? But fair play, you got me.
Nice. Well, that brings us to the end of today's episode. We love hearing from you. If you could leave us a rating or a review in your podcast app or like and subscribe to our YouTube channel as you're watching this, it really does help us get in front of new Equity Mates listeners. And it shouldn't take you more than 20 seconds. But Ren, that's it for this week. We'll pick it up next episode.
Sounds good.
I will say this about investing. Everything you do learn is cumulative. What I learned at 20 is useful.